guys, welcome back to the Capital Mindset Show. Today we're doing another subscriber request. Today we're going to be talking about Foot Locker. So for those of you who may not know, Foot Locker is a popular retail store in which individuals can go there and purchase typically foot apparel, but you can also buy other forms of athletic apparel. And that's actually important to highlight, as you'll see later in the video. So I guess with the first part, we'll always start with the price action, see what's going on. And again, this is a preliminary analysis. So I'm going to be seeing some of this stuff for the first time with you. A little heads up, in order to familiarize myself a little bit more, I listened to the previous earnings call, kind of got a little feel for what it is the business was doing. And I'll kind of summarize a little bit here and there what's important as pertains to the analysis, what we need to know going forward. But for the most part, I believe it was recommended, or at least requested. I use the word recommended and request kind of interchangeably sometimes when I refer to these videos. So not that this individual recommended the stock, but this individual requested the stock, okay? So I believe it's because it's down about 31% from its highs in 2021. And we can kind of start a little bit having a conversation about this. So Foot Locker is part of what we call the old economy. When I refer to old economy, or when you hear the word old economy, you got to think retail, mining companies, stuff that's has nothing to do with technology per se. Now, that doesn't mean Foot Locker doesn't utilize technology for its services. We'll talk a little bit about that later with their rewards program, or I hope we'll talk about that later. But if it's brought up again, I'll go into it a little more in detail. But for the most part, it's just your typical rewards program. So taking a look here, we automatically see, oh, look, low PE ratio. So this is what the retail investor is going to come here and say, okay, low PE, nice dividend, 2.78%, market cap, 4.3 billion. So this is what they'll see on Google, right? Okay, so now let's kind of talk about it a little bit more from the business perspective, okay? And we'll go to the sales pitch, right? The investor presentation, and kind of get an idea of what this business is like, right? So here we have the management team. You can look through them and look up each individual person. I didn't find anything too sketchy about anyone. There may be something, but there may not be something, okay? So just a quick analysis on them. So for the most part, what I expect to see here before we go through this is I expect to see a heavy emphasis on language focused around curating a good customer experience, because it is an apparel, it's a retail experience. So we have to find a way as a business to attract those customers in to buy those products. A lot of the times we are going to be selling other brands. The real margins are Nike or in Adidas. Those guys make the real margins. We're kind of skimming on those margins a little bit. So the focus we want to see is that they have, we're developing our own brands or making different unique partnerships. But for the most part, again, we got to consider that, for example, Nike and Adidas, they have their own stores that they open up. Under Armour has their own stores. So we're basically competing with alongside the same brands that we're selling in our store. Okay, so put yourself in their perspective. And then here, they're saying, look at our execution strategy. So people, women's apparel. Okay, see, there you go, digital, apparel in general. Okay, so here's where I'm going to highlight in the earnings call. You hear a lot of language about how apparel's growing, and foot apparel, specifically with shoes, right? That's decreasing modestly, very tiny bit. Okay, so they're not doing so well. They're not growing like crazy in the foot category, but they are growing in the apparel category. So that is their avenue for growth going forward. Okay, I don't know what they mean by executing their core business. I guess their core business is, foot apparel. I guess that's what that means. European expansion, so expansion opportunities. So these are things that they're going to try to focus on, and I guess also kids apparel. Okay, so taking a look here, they want to show you that they're growing in sales. We like to see growing sales, but also margins need to expand. Okay, and we see margins are kind of So this is, of course, only showing us the 2018, but this is still getting just the idea of the business, okay? And then we're going to see with the most recent numbers if they did anything regarding that. All right, so just remember some of these margins. Margins 9.3% and EPS. Okay, I don't care about that right now. This is something also interesting to actually take note of, the sales per square foot for retail businesses. If you guys go do your analysis on any other retail business, hopefully they provide this. It's not technically necessary under GAAP, but the sales per square foot of the facility. This kind of shows you how efficient is this business with regards to its real estate profile. And you want to see this going up, of course, but you can compare this to other competitors and kind of see, are they efficient? I'll show you some of their initiatives that they talked about a little bit in the video conference, that they are maybe hopefully going to touch upon in this presentation. Return on invested capital, we want to see this above what we believe we could otherwise do in the market. So think of like, if you think you can do 10% rate of return in the S&P, you want this to be above 10% because you're kind of comparing it to your opportunity cost here. Okay, so we're on a journey. Okay, whatever that means. That's the video for another conference call. Customers moving faster than ever before. So this is where I guess they're going to talk about youth culture. Yeah, shifts in consumer behavior. This is definitely going to talk about youth culture, I bet you. That's typically a word they use. And then our customers discover new brands. Okay, so this is, if you ever took a marketing class in college, this should be very familiar to you. This is the stages of adoption. So adoption stages. Yep, there it is, youth culture. Okay, so basically the changing stuff, when you start to talk about that, they're going with youth culture. And youth culture is very difficult to attack in apparel because it's always changing. There's always new young people coming in. It's not like you're following them as they grow up. You're always kind of just targeting the next youth culture that comes through, and those tastes are consistently changing. But there's always money to be made. Just because it's difficult doesn't mean it's a bad investment. There's always money to be made in different opportunities. Okay. And then again, our vision to create youth culture. So I'm not going to spend too much time on that because I don't want to waste you guys' time. Okay, so these are like their 5 pillars or whatever. And let's move on from that. Okay, so is there anything else in here that we would want to talk about? Digital experiences, we already know that. Okay, this is actually, okay, here it is. So this is the nomadic concept. So they're actually building out these nomadic concepts, which is basically seems to be a convenient way for us to shop for shoes. So they have this truck that comes by. They have these outdoor things. Okay, then they have their power stores, which is what I traditionally thought of, and then high profile stores. So the big ones, the ones that are in very high prime real estate. Okay. All right, so that's cool. Okay, this is their digital experience, right? All right, so let's see here. So they're investing a lot in their social media presence. Okay, that's what that means. They're trying to do that. They're investing a lot in their applications, trying to get that consumer engagement that brings loyalty, and then investing in that website. There's nothing worse than me going on a website, or not me per se, only me, but all the consumers out there going on a website and just things just not working out. You want to find out where the things are and put it in your basket and then pay for it and take it out. And if they can do that with an app, even better, So we want to see that improving. We want to kind of keep track of that. The only way to keep track of that is for us to download the app and kind of go through that. But for the most part, I checked it out. Seems pretty easy, nothing too crazy. But again, I don't know how, someone who's technologically challenged would handle it, but I think it looks pretty easy. All right. Anyway, so they're trying to do new experiences. Okay. So House of Hoops, courtside. Okay. Nike Home Away, and NCX. I don't really know what the NCX means. So, okay, then their Adidas partnership concepts. Okay, so I think we can move on from here. And so that's pretty much the sales pitch of the business. So one thing I want to take note of before we actually go into the model is I actually pulled up, let me see if I find it. Where did I shove it? Here it is. All right. I shoved this over here, and hopefully everyone can see this, but if not, I'll describe it to you if you guys aren't actually watching the screen. What we see is from October 2020 to October 2021, cash flows from operations, right here, I'll highlight it here, has declined significantly. This is not so good. And this is the 39 weeks ending in that time. So it's not the full year. And what can be attributed to this, your eyes might have already seen it, but it's this change in inventories or merchandise inventories. That is the main driver. And essentially, they're spending a lot of cash on inventories. This makes sense. When you hear the conference call, what you hear is, hey, supply chain, supply chain, supply chain. We've heard this from every company that has to do with inventories, supply chains. So they're attributing the costs or the extra costs to the supply chains. Go figure. So let's just take their word for it, I guess, and really not question it too much. All right. So from here, let's actually go into the model. And I actually have pulled some stuff up within the model, and we'll actually start with the key ratios so that we can take a look at some of those other ratios that they were showing us in that presentation, see if they've improved. All right, first things first, let's look at that balance sheet. All right, so current ratio, pretty good. Cash ratio, it's getting worse, but that's not a bad thing per se, because the cash ratio is the most conservative. It's basically the cash that they have on hand and their current liabilities. So, don't be too hard on them there. And the total debt ratio, okay, so that's getting up there, but I don't think that's really in the form of long-term debt. While it has been growing, it's almost doubled. The debt per se is still manageable. Okay, most of that debt's probably in the payables part. Okay, it's not really in the actual debt that they owe. It's in the payables part, and yeah, that's accounting for you. So long-term debt to capital. Okay, things are getting a little bit worse, but nothing crazy. Debt to equity, nothing crazy. All right, this is where we start to see the margins, right? So net profit margins, we see that they indeed have gotten better. Okay, they've gotten better since that 2018 number. They've gotten better since the 2018 number here as well. Net profit or ROA has gotten worse, but still within line, still above average. And then ROE is actually the highest it's ever been. Awesome. All right, good on them. All right, these are good numbers. All right, let's take a look over here. So usually very good. Only recently it's actually dipped down. Not so good if you ask me. Okay. In isolation on a free cash flow basis, this usually is trading cheaper versus its GAAP net income, but more recently it's the opposite. And that might have more to do with the change in inventories. They're spending more on inventories, and that's not necessarily a GAAP net income expense. Okay. So, but it's a cash expense, and that's probably why. So taking a look here, the reason why we care about the activity ratios for a business like this is that they sell inventory. All right. For those of you who are new to the channel, we look at this at the end, and we emphasize this on Capital Mindset when we're looking at a business that deals with a lot of inventory. All right. So taking a look here, we have the inventory turnover that's higher. And by the way, this column's always here to help you guys follow along. And cash conversion cycle, this kind of is indicative of a company's power with its suppliers. Of course, they're not going to have the power. Nike, Adidas, and all the other companies that they sell their merchandise to, they have the power, not them. So the cash conversion cycle is going to be a little lower. And usually when it's a negative number, that means it's indicative of high power. We've done videos in the past on this channel, showing Pepsi compared to other food companies, and Pepsi had a negative number. The other food companies had higher numbers relative to Pepsi. So I showed that Pepsi was really top dog. Okay, so with that being said, let's actually move over to the summer report and start talking about some of this stuff. So according to the analyst, this is a buy with a 62.52 buy price, implying a 44.8% upside from today's price of 43.14. I'm trying to be a little bit more descriptive, by the way, just in case some people, are not watching the visuals of the video. So from now on, I'm trying to make that a habit. Okay, so right now in the model, we have plugged in a 15% required rate of return. We are assuming no buybacks or no share dilution. And we're not going to worry about these growth rates just yet, but just in case, the 4% is already included in there on the midpoint. And then on the high point, I actually think that's really high. So let's go with 10. And then let's go with the middle point of 7. And then we have room to be a little bit more conservative. Let's go with -5. And I think we can go 1%. Okay, so for now, it appears that the model is returning a buy rating as long as we can assume what appears to be. Let's actually start playing around with this and see what is the lowest we can assume at the current discount. Okay, so almost a -2% growth rate. Okay, so between a -2, so just above a -2% growth rate, we could assume that and actually eke out potentially a 15% rate of return on this business. So some details, though, because it's not so simple, right? Some details I would like to go over is, for example, the ability of this business to actually utilize certain parts of its business regarding its cash distributions, right? So we know they pay a dividend, right? We saw that in the beginning of the video. And we also see that they've been doing a buyback. I didn't assume buybacks in this valuation so far because I wanted to be a little bit more conservative. There are some uncertainties with a business like this, and I will show that in the discount rate in just a second. But before we get there, because they're doing buybacks, this dilution accretion number, we're going to ignore it because that has only to do with things that are or not things, companies that are diluting us. And then that's supposed to be the dilution accretion, right? But they're not diluting us. So this business basically isn't using a lot of debt. We can see that in the market cap versus the enterprise value. Remember, the enterprise value is calculated by taking the market cap and then adding the cash, right? Sorry, adding the debt and subtracting the cash. Almost messed up there. The enterprise value, when it's lower than the market cap, is a quick indication that they have more cash than total debt. Okay, that's a very quick indication. As soon as you see that, doesn't mean you shouldn't dig further, but it's a very quick boom. Oh, you have more cash than debt. All right. So the estimated WACC, remember, this is a kind of a customized WACC, basically would say if they were to use equity in a certain proportion, continuing that as they've done in the past into the future, it'd be very costly. And then you want to compare the COCR with the estimated WACC. This is why both calculations exist. This is a customized calculation. This does not exist on the internet. You will not see this. It kind of tells me what the management is doing, right? And so the management is actually doing things in a way where the cost of capital is actually, about 2.46%. So this is pretty good. It means management's doing a good job. Okay, that's good on management. It also is estimating that or at least what the WACC is telling me, it's kind of being influenced by the model because the model is saying it's basically pretty cheap. Okay, so it'd be very expensive for them to utilize equity at this moment. So you really, really, really don't want them to be, if you agree with that, you do not want them to be diluting you, right? You would really, really want them to actually be buying back shares at this moment. And that would actually be accretive to the value longer term of the remaining shareholders if, it's undervalued. Okay, so let's actually discount it at 20% to indicate a greater degree of uncertainty. And now here's where things get a little interesting. So we can't actually assume the 4% growth rate that they've averaged so far. We actually have to assume greater than that in order to achieve a 20% rate of return. Of course, I'm not assuming any buybacks. The buybacks would be an icing, like icing on top. So what I can see here so far from this business, based on everything I've seen, it is pretty cheap. Now, here's some risks. So we don't want to see margins come down a little bit. If margins come down a little bit, then we're going to have to lower our growth rate expectations on the cash flows. And if that were the case, then you're probably, safer bet is to somehow get it at a price where you could assume a -5% if you want to be at the most conservative. Well, you could always go more conservative, but just for the sake of this argument in the current picture of the valuation. And I think for me personally, it is actually a very interesting company. It's very compelling. I think I'm going to look a little deeper into this company. The only problem is because it's retail, it's so fast paced. It's not typically a type that I like to add to my portfolio. However, I do acknowledge that for those of you who are seriously considering this investment, it can be a good investment, right? It's very feasible, very probable that it could be an excellent investment. But I don't know if it's for me. Okay. So there are plenty of investments out there that I'll find that appear to be, all the ducks are lining up in a row. But there's an attribute that just turns me off or turns me away from the business. That in no way, shape, or form means that you should do that, right? Because I am not, quote unquote, the way. I am simply just providing my perspective. And my perspective is simply put that this business, yes, it's cheap. It's very cheap. Can it grow? I think it can. All right. Is it within my circle of competence? No. In fact, I'm actually hilariously ignorant of shoes and shoe culture. Very ignorant of that. So I don't belong anywhere near something like this. But if you are, and you can kind of take that skill, that knowledge that you have, and then better apply that in this instance, then you may make the case for yourself and wrap your mind around the thesis of investing here in this company. Oh, and by the way, I said that you had to assume greater than 4%. 4% is just at the level where you'd have to assume, which is basically an average. So basically, the market's kind of pricing this in and kind of pricing in a lot of uncertainty. So, but again, I do think you could do good. you may do good. All right. But the information I'm lacking is a fundamental understanding of shoe culture, the strengths of Foot Locker in comparison to others. For example, from my mind, this again comes from a normie mindset. I'm not an expert in shoe culture. Well, what's stopping Nike from just taking over and just selling shoes directly? Why don't people just do that? You might have the answer to that. I just don't. Okay. So a very interesting company to look at. I actually enjoyed that one. If you guys have any other requests, feel free to leave a comment down below and I'll sure to add it to the list. Again, remember the rule, no microcaps unless there's a lesson to be derived from it. With biotechs, no microcap biotechs or pre-approval biotechs. And I think that covers all the criteria. Other than that, everything's fair game. Remember that I'll be trying to do a recommendation once a day at least. I'll be trying to do it. There'll be some days where I miss, but I'll try to do it my best on that. And if you guys like content like this, you guys know anyone who's looking at Foot Locker, feel free to share this video if you think it provides value. And if you guys don't think it provides value, just leave it here on the neither. All right, guys, have a good one. Bye.